Okay, a very good morning, very good morning. So today's topic, I hope we're all doing well, first and foremost, of course. Today's topic is all about market volatility. So we're going to be looking at the best volatility indicators to use in your FX trading. So by way of a quick introduction, my name's Aaron Hill, and I am one of the market analysts here at FP Markets. Now, there should be no issue with sound or the slide deck. That should all be coming across loud and clear, and it should be very, very visible, as this was double checked before we went live. So do be sure to let me know if there are any issues, and the support team will help you try to help you get things going. So in terms of a recording for the presentation, there will be a recording of this presentation available either through the FP Markets website that can be found under resources on the main web page, or alternatively, you can go to our YouTube channel, FP Markets, and look at all the archived webinars there. There we have a number of different webinars. We have, a number of different webinar subjects, hosted by a number of different speakers from different parts of the world. So it's well worth checking that out. Now, in terms of this presentation, it's fine to fire across any questions you have during the presentation. But if it's something you feel may require a more in-depth response, please consider waiting till the end of this presentation, as we may clear up any of the inquiries as we proceed. All right, so as usual, guys, quick disclaimer. The information contained in this material is intended for general advice only. It does not take into account your investment objectives, financial situation, excuse me, or particular needs. I'm not going to read out the entire text there, but suffice it to say, this is not investment advice. This is simply an educational presentation. All right, so the agenda for today's event is, as you can see, we will be defining volatility first and foremost. Now, I do find that many are confused between volatility and momentum, many newer traders, that is. We'll then be looking at popular volatility indicators used by professional traders. I'll mainly focus on TA, technical indicators here. And then how can I use these indicators in my trading? Just to be clear, I personally do use all of these indicators in my trading and in my analysis. So I find that these have offered the most use over the years. And then we'll finally round off with a Q&A. So any questions I miss or any that may have required a more of a detailed answer during the presentation, this is where I'll try to address them. Look, you can always email the research team as well at marketanalyst@fpmarkets.com, or alternatively, you can email the support team at support@fpmarkets.com as well, and we'll get back to you as soon as possible. Also, please do be sure to send over any topics you may want us to cover in the near future. So look, I feel this is a very important part of the presentation. Namely, I'm going to define what volatility means in the marketplace. As I said, I see many new traders confuse volatility and momentum. Now, if that's you, then this may help clear things up. So volatility is simply the fluctuations within the market. So we can think of this as almost like the ups and downs of price action of a security, and really measures how extreme its price swings are. Now, volatility is also commonly referred to as a proxy for risk. And what you'll find is that traders and investors analyze the past historical volatility to assess future or implied volatility. So let's imagine here we have the price of the euro dollar. The euro dollar currency pair, very popular currency pair, widely traded. And the higher price swings at this point here and down at this point here represents, can be referred to as high volatility. So this price level here, we can think of this as the average. So just think of this as, in very simple terms, as the simple moving average. And the price movement around that moving average is considered the volatile component of price action. So the largest price swings are considered high volatility and can be seen as a market for deriving profits. But, and this is crucial, but it is also seen as a riskier market as well. I'm sure we're all aware, but risk and reward go hand in hand. If you want the chance at generating greater returns, you have to accept that these investments carry greater risks. So turning our attention to the smaller price movement, you can see here, the smaller price swings. This is referred to as low volatility. As you may remember, the horizontal black level here is the average, and we have smaller, smaller price swings, ups and downs, if you will, within the market. And again, this would be a less risky market than one with higher volatility, but also at the same time offer less on the return side of things. So I'm just going to check if there's any questions. There's no questions. Fantastic. All right. So I'm going to switch things over to our the TradingView platform. Just bear with me, guys, and then we'll. Because this will help us with our understanding of the indicators. So on the screen right now, you should see the euro-dollar chart on the daily time frame. I'm just going to double check I am sharing the correct screen. Okay, so as I said, you will on the screen right now is the euro-dollar daily time frame, and also we have the ROC indicator applied. So just so we're all on the same page, volatility or the price swings is different from momentum. Now, momentum measures the velocity or the price change and is measured continually by taking the differences for a fixed period. Now, for a technical analyst, a simple indicator to measure momentum is the ROC. As you can see here, it's applied to the bottom part of the EU chart. And the ROC indicator is, or the rate of change, is calculated by subtracting the difference in closing prices n times. So that could be 10 times, that could be 5 times, that could be 14. So this could be a 14-day ROC, for example. And then we divide that by the oldest value, by the oldest value, and then multiply that by 100 to get our rate of change in percentage. Now, the reason I really wanted to highlight this is because I wanted to differentiate between momentum and volatility. Now, the ROC indicator, as you can see here, is really it's unbounded. So, but it can still offer overbought and oversold conditions. Now, in order to achieve this, we would need to manually apply these overbought and oversold conditions. So you could use these two lows here as your projected oversold region going forward. You could also use this area here, as you can see, this point here, this point here, this point here, this point here, as your over. Let me apply the lines here because that would be easier for you to see them. So this would be your oversold level, defined by the recent indicators movement, and there would be your oversold level. So as I said, it's an unbounded indicator, but it can also offer divergences. It can also offer trend identification when you cross above the 0 line. Now, this is not the purpose of the this presentation to discuss momentum indicators, but I will quickly mention the RSI indicator as a more advanced way if you're interested in looking for momentum. Again, guys, look, momentum measures the price change and is measured by, as I said, continually taking the price difference over a specified time period. Now, the RSI, as you can see, is a bounded indicator and has defined overbought and oversold limits. If you want to look more into this, do consider searching this on through our Trading Academy, where we have an in-depth video on the RSI. Now, onto volatility indicators. My first port of call is the Bollinger Bands. Now, the Bollinger Bands, so I assume, look, guys, if there are any questions regarding an understanding of what volatility is, now is the time to ask, because I'm going to assume that we all understand what volatility means. So I can now turn my attention to the Bollinger Bands. So there are a number of different volatility measures you can use in the technical field. I do like the Bollinger Bands, and I also like the ATR, the average true range, both of which I will be discussing shortly. And both of these fit firmly into the bucket of volatility indicators among technical analysts. Now, just to be clear, I am not in any way, shape, or form saying that the Bollinger Bands or the ATR are two of the best volatility indicators. Though these are indicators I have personally used and continue to find use in during my own trading and analysis. Therefore, first and foremost, how is this indicator constructed? What does it measure? And importantly, how can we, as traders and investors, use it to generate investment advice? Just to set a little bit of context here, the Bollinger Bands was developed by a chap who goes by the name of John Bollinger. This was in the early 1980s, and Bollinger Bands are designed to evaluate price volatility. And really, guys, I'm pretty sure you've all heard of these. Bollinger Bands are very, very popular among technical analysts, and for good reason. So just quickly, volatility it's a reflection of how much price fluctuates around a mean or an average price. It is not the momentum, which measures how quickly price movement rises in an uptrend, for example. So if I just zoom in here, you can see that Bollinger Bands are centered around what's known as a dynamic value, a moving average. Now, in the case of Bollinger Bands, this is usually set to 20 periods. If I click on the inputs, you'll see the length is 20 periods, and the source is close, but it doesn't say whether it's, it should say, one second, it should say whether, look, Bollinger Bands are set to a simple moving averages. So we can all assume that this is a simple moving average, not an exponential moving average, which gives more weight to more newer price action. So the simple moving average is an equally weighted average. And this is set to 20 periods, which is the default period set by Bollinger himself. Bands are then applied. As you can see, we have an upper band and we have a lower band, and bands are applied a number of standard deviations away from this moving average. Now, 2 standard deviations are the default. One standard deviation, just to add a little bit more context here, one standard deviation contains around 68% of the price of price movement within the bands. Now, 2 standard deviations imply 95% of price movement is contained within these 2 bands. If I just go to the inputs again, and I want to change that to 3 standard deviations, which contains around 99.7% of the price action, you will see, there we go. It's almost, is rounded up, it's 100%. So 100% is contained within the bands. So that's up to you. You'll have to back test that to see how effective it is by switching from, say, 1 standard deviation to 2 standard deviations, or even 3 standard deviations. But for the purpose of this presentation, we will work with the 2 standard deviation, which is the, as I said, the default period, default standard deviation. Now, Bollinger Bands, and this is important, Bollinger Bands determine if the current currency pairs prices, assuming we are trading FX, which we are in this case, are low or high relative to its moving average, its average price. That should make sense after our brief discussion on these slides regarding the average price and the swings in volatility. Now, how can we use this indicator to help generate trading decisions? Although some are against trading the outer bands of the indicator, what I mean by this is the two standard deviation bands that are applied plus or minus the moving average. But I have personally found it very useful to trade for trading the extremes of this indicator when, now this is the very important part, when considered alongside the underlying trend. Now, I assume that we are all capable of detecting a trend, identifying a trend. Now, there are indicators to help with this. We have moving averages, we have the ADX, and we have basic price action structure. For me personally, I always favor the price action because most of these indicators are a derivative of price action anyway, especially the simple moving average, of course. It's just an average of the, in this case, 20 days, an average of the 20 previous daily closes. So anyway, it's very clear that we are in a downtrend at this point, right? So we have a lower low, lower high, lower low, lower high, lower low, lower high, a series of lower lows and lower highs. This defines a downtrend. Now, what you can do is you can apply the Bollinger Bands to this to detect, to identify when the currency pair is high, according to two standard deviations of this moving average, when the currency pair is high relative to the as I said, to this moving average. And this could be an ideal opportunity to begin shorting this market. So as you can see here, we have, I wouldn't have taken this option here because at this point, we're still, sorry guys, we're still very much within a range after coming from an up move. So I would have waited for this low to be broken here, which it was there, and then considered this opportunity at this point here. Now, at this point here, we also have, I'm pretty sure we can all see this, we also have what's known as a shooting star, a bearish candlestick formation. This could have added, assuming we look at candlesticks to confirm price levels, this could have helped confirm that we are potentially heading lower. So again, look, you can use other technical components to, of course, to confirm the upper Bollinger Band. But the first and foremost for me is detecting or identifying the trend. So we've done that here. We have a lower low and a lower high. We are now testing the upper band. Then we come down, we come down, we come down. We form a lower low, a clear lower low. And then again, we test the upper bands at this point here. Now, at this point, we don't really have anything in terms of a bearish confirmation in terms of the candlesticks, but we have indeed retested this level. What you could have done is then looked for maybe even a trend line resistance at this point here. Of course, it's not, well, it's nearly, I mean, it come within a few pips here, guys. So we could have, whoops, let me draw that on properly. We could have also used, we can also use, I know this is a volatility based presentation, but we could have also used the RSI in these cases to help detect when we were overbought. But just to be clear with the RSI, when you're in a downtrend, you will often find that a temporary overbought region forms between 60 and 40, as you can see here, between 60 and 40. So you would have had to, at this point and at this point, taken this as overbought, temporary overbought, that is. But it's just a way of, what I want to do here is open your eyes maybe to different ways of trading these. Again, you will find your own way. You could use other technical indicators. You could use price action, whatever you feel that's comfortable, in addition to the underlying downtrend as we have here and the upper Bollinger Band. I would never take counter, this is just me, guys, personally. I would never take counter trend trades off of the Bollinger Band's lower boundary. As you can see here, a long would have proved, you know, I'm not going to say it wouldn't have worked out. It depends on how you enter the market, because you could have drilled down to the lower timeframes at this point and taken the counter trend trade. But I'm just trying to show you the most easiest and for me personally, the most profitable way of trading the trend using a volatility based indicator. Again, we had points here, we could have entered short. Yes, this would have been a tricky one. But look, what I would have looked for is up at this point here. You could have looked for another shorting opportunity here. Of course, we missed it here. Another decisive lower low, another test of the upper boundary here, another couple of decisive lower lows at this point, but then we test the upper boundary here. It goes on and on, another test, and another test. Even though the trend had changed at this point, we still got a nice move to the downside. Now, you may be asking, where do I place stops? Where do I take profits? Now, again, this will come down to your individual trading strategy, but as a basic, you could look to target the 20-day simple moving average, the inner band of the Bollinger Bands. That could be a basic, but for me, I always look at price action and the overall technical picture as well. So if we have a key support down at this point here, coming across the chart here, I will always look at that as well. I don't tend to rely too much on indicators to take profit, but you will see the ATR is very good at helping with this. We'll touch on the ATR very soon. But yes, as you can see here, we also, so as we've transitioned into an uptrend, higher highs, higher lows, higher highs, higher lows. And then what happens here, we test the lower boundary because now we're looking for longs, right? We're in an uptrend and we're looking for longs. So yes, quite simple. A long opportunity was seen here. This was a very difficult one. So that, as I say, with every technical indicator and every technical strategy, there is no guarantees that each trade will be successful. So here it would have been a very difficult position to be in at this point here. You would have obviously found a nice opportunity around this point. There was actually a triple bottom. There is a triple bottom that's recently come into play here, that we had a bottom 1, bottom 2, and then bottom 3. Initially, I was looking at the double bottoms here that touched the lower boundary of the Bollinger Band. And this would have been a nice long opportunity for me anyway, personally. That did, look, if we had our stops placed below the Bollinger Band, we would have still been okay. And we would have still been in this trade. So that's the main point here. Are there any questions regarding this? It's pretty self-explanatory. Again, identify the trend, and then look for potential opportunities within the trend at the respective Bollinger Bands, the extremes. So again, here, a long opportunity. I wouldn't have taken this one here because we haven't really, because look, the trend is here, higher high, higher low. And then I would have expected price to continue. The expectation would be for price to continue higher. We didn't get that. We stopped at the upper Bollinger Band and came back down to test this Bollinger Band. Again, you could have taken this in anticipation of a double bottom, which did actually work out. But for me, I would not have taken this trade. I would have taken this trade because it aligns nicely with the trading strategies, rules of engagement, if you will. And again, here, another downtrend, clear downtrend, opportunity to sell, opportunity to sell, opportunity to sell, 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 sell. It's all about the trend, guys, with this Bollinger Band, for me anyway. Right, so I don't see any questions regarding this. There are another method you may see applied with the Bollinger Bands is referred to as the Bollinger Squeeze. Now, one second. Bollinger Squeeze is a popular trading strategy, but not really one that I have personally found much use in. So the Bollinger Squeeze is the Bollinger Bands identify a period of contraction, a contraction in volatility. So it's a shrinking volatility. And according to Bollinger, this is often followed by a phase of high volatility. So volatility contraction or band tightening is said to help forecast significant moves in either direction, particularly when the outer band is penetrated. And this kind of goes against what we were saying just a minute ago, the strategy that you could use to trade off the most extreme bands within an uptrend. I just want to see what the outcome is if we switch to a 3 standard deviations. I mean, let's just see what happened here. See, we would have got an opportunity here. See, the opportunities are certainly decrease, but they seem to be, you would have an opportunity here to short, here to short. at this point, we are in an uptrend. And look at this. Wow, that was a to the pip test there. So you could consider looking at this to decrease. Of course, it will decrease the opportunities, but it seems to increase the probability of a trade working out. So we are now working with 3 standard deviations here, guys. Potential shorting opportunity at this point here, these points here, this point here, here wasn't one here, and here as well. But look, we are now looking at an uptrend, a possible uptrend change at this point here, because we have a higher high and a higher low. So do bear that in mind. Let me just switch back to the 2 standard deviations. Okay, so the periods of shrinking volatility, or the Bollinger squeeze, I've highlighted at this point here. And this is when, as you can see, the bands are noticeably tighter than previous. And what that shows is the volatility has indeed decreased. So what we do is we look for, let me zoom in. This is the best one I've found. So what we look for is a period of shrinking, as you can see, a very widening of the bands here, an increase in the band width here, but a decrease in the band width at this point here. And this is, as I said, shrinking volatility. Test, 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 test. We have I wouldn't even call that a breakout. This is the breakout I'd be looking for here, if you were indeed looking to trade this. So you would enter long, maybe on a buy stop above the high of this candle here, and then place your stop either below the 20-period simple moving average or indeed the lower boundary of the Bollinger Bands. Now, what I will say about the Bollinger Squeeze is it is very good. It is very good at identifying trend reversal opportunities. So imagine we were coming down lower here, and price has been trending lower. And then we get this long period. It's not really a long, but imagine this a longer period here of tightening between here, and we get a decisive close to the upside. This can be considered a trend reversal because we've closed outside of the bands. Now, if you were within the trend, I would have said that this is not a buying opportunity for me personally. Some may disagree here, which is absolutely fine. This is how the market works, right? This is what makes this industry so great. It's so flexible, and we can all trade different strategies, but and still make money. Right, so that's the Bollinger Squeeze. We look for a close outside of the bands following a decrease in the band width. So here's another one here. This one wasn't so great because, look, I was ultimately looking at this close here. I think it was this close here. But look, prior to that, we also got a close here. So this would have been a whipsaw. This would have been a false signal. Then you would have taken the long at this point here and potentially placed your stops above this SMA, and that would have worked out nicely. There was another one I highlighted as well here. As you can see, we had an uptrend and then a period of consolidation, so a period of band tightening. This would have been a signal potentially to short the market. Again, depending on how you manage your trades, you may have been thrown out of the market here. And a mild close was seen here. Again, you would have been thrown out until this point here, which you would have taken a long position and then tried to ride the trend. But again, for me personally, I always look to trade the extremes of the bands in line with the trend. Now, for 1 second, guys, I just need to make sure I have this other chart on. I'm sorry about this. There should be another chart. Just bear with me. Bear with me, guys. I apologize about this. Okay. All right, excellent. So the next chart here is the S&P 500 and the VIX. Now, the S&P 500 and the VIX are, some may not understand what these are, what these markets are, especially newer traders. So the S&P 500, the upper chart here, is the daily time frame, and this is largely operated by the S&P Dow Jones indices, and was formed, I think it was at the late 1950s. And look, this was the first US market cap weighted stock market index, and is now regarded as the one of the best single gauge for large cap US securities. The index holds around 500, to be precise, it's 503 securities. of the leading companies listed in the US. And interestingly, it covers around 80% of the available market cap. Now, for anyone that's interested, the largest constituents within this index are Apple, Microsoft, Amazon, Nvidia, Tesla, and Berkshire Hathaway. Now, the largest in terms of the sector breakdown, IT control, it really controls the largest piece of the pie, if you will, and that's at around 27% in terms of sectors, in terms of companies related to the IT sector. And that's followed by healthcare at 14%, and then financials are at around 12%. Now, if you're interested in learning more about the the S&P 500, you can always check out their fact sheet on the S&P Dow Jones Indices website. In fact, I would highly recommend that. Okay, so now what is the VIX? Let's remove the Bollinger Bands here just for the minute. So the VIX is a volatility index. And what it offers is the expected, very important, guys, expected volatility in the S&P 500 index. And how it's calculated is through S&P 500 index options. It is a rather complex calculation that is performed by the CBOE, so the Chicago Board Options Exchange. Now, the VIX is also referred to as a fear index or a fear gauge. Overall, the VIX represents, this is important, guys. Overall, the VIX represents one measure of the market's expectation of stock market volatility over the next 30-year period. Again, this is where it becomes a little bit confusing. Just bear with me. So, as you can see here, I hope you can see, the VIX is currently around 21. So if I get the pen out, so the VIX is around 21, okay? 21, this is our VIX level. Now, although the VIX represents the market expectation of stock market volatility over the next 30-day period, it isn't expressed as a percentage, and although it can be understood as one. The VIX actually represents an expected annualized change with a 68% probability. Okay, I hope this makes sense. So 21%. So we can expect over the course of the next year that the VIX, that the S&P 500 will move 21% or 21.3% in either direction. So with the S&P 500 currently trading at 3,936, this means we have a 68% probability, of less than 21% in the S&P 500, again, in either direction. So this is a projected range of around 826 points for 21% of 3,936. So the projected range is between, if you work it out to calculate the percentage, is between 3,100. This is the S&P 500 index levels, and 4,762. Bear with me. So this is your projected range according to the VIX at 21. This is your projected range, an annualized projected range. So we could see for a 68% probability, we could see these two price contained within these two values. So the expected volatility for a single month, now this is where it becomes a little bit more confusing, can be calculated from this VIX figure. So 21, let's move up here, 21. By dividing the VIX index level of 21 by the square root, so the square root of 12, which gives approximately, I think it was 3.46, I think it is, 3.46. So that's the square root of 12, 3.46. And then all we do is we divide the VIX index level, so 21% there, by 3.46 to give us, I think it was around 6%, 6.07%. 6.07%. Now, this means within over the next month, a range of around, I think it's around 240 points. 240 points could be seen over the next month. So approximately 3,697 and between 3,697 and 4,175 in a month. This is on the S&P 500. We can even take this down. Sorry, guys. We can even take this down a little lower and look at the weekly. The expected volatility for a week would be taking the square root of 52. Square root of 52, which is around 7 something. 7, I'm just checking my notes, 7.21. 7.21. And then what you would do is divide the VIX, which we know to be down here. Look, you can go into more detail here, 21.35 if you want, but just for the sake of this presentation, I will keep it pretty simple. Divided by 7.21, then we'll give us a weekly VIX price level of 2.9%. Now this is rounded, guys, so 2.9%, and 2.9%. Then you would work out what is 2.9% of the current S&P 500 level in either direction, so either to the upside or either to the downside. And this is your one standard deviation for the S&P 500. Now you can also work out the daily if you really wanted to go there. You can work out the daily expected volatility, and you can find this out with the square root or through the square root of 252. So you would then divide 21 by the square root of 252. I'm not going to go into that. But the square root of 252, of course, is 15. I remember this, 15.84. So this is a way of projecting implied volatility for the S&P 500. I hope this makes sense, guys. Now, while there are other factors at work with the VIX index, a high VIX really reflects increased investor fear, and a low VIX level. So a high VIX is around 30, I believe, what many consider high, and a low VIX level is below 20. So a high VIX reflects, as I said, investor fear, and a low VIX suggests complacency. So historically, the pattern in the relationship between the VIX and the behavior of the stock market or the S&P 500 has repeated itself. So we have an inverse correlation. So when the S&P 500 rallies, we often see a decline in the VIX index. Now, just to be clearer here, so I can show you. So this is this point here. Let me move this over here so it makes more sense. So as you can see, we start topping out at around the 35-ish level on the VIX, and then we see the S&P 500 begin to bottom and look to the upside. Again, look, we have clear resistances formed on the VIX around the 35 area. So we can expect each time this area is tested that the S&P 500 will bounce to the upside. So how do I use this, and how have I used this? How do I continue to use this? What I've found is, and I got this from a very experienced trader many moons ago, and what he told me to do is, if you really want to use the VIX with the S&P 500, quite simply apply to find overbought and oversold levels, quite simply to apply the Bollinger Bands and overlay that on the VIX. And it has proved to be very, very successful. So as you can see at this point here, let me mark this up for you. At this point here, we know we are at a 2 standard deviation level. According to the Bollinger Band, according to, according to the Bollinger Band's 20-period simple moving average. Now, with that being said, what I look for is, I look for a defined close outside of the 2 standard deviation, and a close back within the Bollinger Band, because what happens is volatility expands, then contracts, and then generally reverts back to its mean. So we have a defined close to the upside here, and then we close back lower. Now, if you can look at the upper chart, you will see a mild, let me move that here so we're on the same page. As you can see, we closed higher and then closed lower and we did get a mild push to the upside. But it's here is where we start to see price actually rally. So you have to be careful. You have to still include other technical components here, but this is certainly a way of identifying periods of a volatility contraction. Here is another one. This is something I noted in a recent analysis as well. We closed higher here, but look at the S&P 500 in the upper chart as we're closing above and then coming back into our from our 2 standard deviation of the Bollinger Band. We have indeed pushed to the upside. And I said there is a chance in the analysis that we could push back above our 200-day simple moving average. And we have indeed done that. So this is certainly something I would keep an eye on. Here we had another one. Look at this. We had a defined close to the upside here, and then a push back lower. If you look at the upper chart there, we did bounce off of the 200-day simple moving average. Let me move that over so it's nice and clear for us all. We had a close outside of the 2 standard deviation, then a close back in. And then what happened was volatility contracted. And remember, a low VIX level suggests complacency, suggests a lack of fear. And then we got a bounce to the upside off of the 200-day simple moving average. So this is certainly something. I'll just go over here. This one here. This is a nice one here. Let me just move this over here. Again, a defined close to the upside and then a close back inside of the 2 standard deviations, the upper band of the Bollinger Band, the 2 standard deviation, and then we bottom out on the stock in the S&P 500. Now, a rally in the S&P 500 doesn't mean we have to trade stocks, right? We could also trade the pro-cyclical currencies. We could trade the Aussie, the risk-on currencies, the Aussie dollar, the New Zealand dollar, the Canadian dollar as well. And and things like that. So this doesn't mean we have to trade the S&P 500 necessarily, but I would always look for, I always keep an eye on this because it's proved very, very high probability in terms of looking for a rally a rally in the S&P 500. Okay, finally, moving over to the final chart, again, on the euro dollar. Now we're looking at the ATR. Now, this is the average true range. So the average true range is one of the most popular and widely used TA indicators. It tracks the volatility of a particular market, very similar to what it does on the Bollinger Bands. Now, just to add a bit of context here, the ATR does not indicate the market's price trend. And what it does is it only measures the degree of its volatility. Originally, this was introduced, the ATR was introduced for use in the commodities market. If you do a bit of research on who invented the ATR and what its initial use for was, you'll find that it was for the commodity markets, and since then it's been applied to a number of different securities, stocks, currencies, bonds, you name it. The ATR does its job. Now, Jay Wells Wider is the gentleman behind the creation of this indicator, and it was I think it was introduced in his book, the New Concepts in Technical Trading Systems. And I think this was in the late 1970s, I think. But look, Wilder is the founder of several different indicators. And so think of the RSI, the ADX. Wilder was behind all of those. Right. So how do we go about calculating the ATR? As an understanding of the formula can really help, I feel. So the first port of call, of course, is to calculate the true range. And as you can see here, we use 3 methods to do this: the current high less the current low, the current high less the previous close, and the current low less the previous close. So we take the greater of the 3 of these calculations. All right. So once we found that, we can then we don't even need to find this really, because what you can do is if you want to continue calculating the ATR, look, you don't really need to calculate this because most trading platforms do this for you, but it's just in case you want to dive into the math behind it. So the current ATR equals prior ATR. So you would take the prior day's ATR if you're looking at the daily time frame, multiplied by 13. then plus the current true range, which is found here, the greater of these three, and then we divide that by 14, assuming you are looking to keep with the default period of 14, as suggested by Bollinger. Now, again, Wilder designed the ATR with commodity daily prices in mind. Now, commodities are generally more volatile than stocks. You wouldn't say that considering banking stocks at the moment, though. They were often subject to commodities were often subject to gaps and limit moves, which occur when a commodity opens up or down to its maximum allowed limit for the session. So a volatility indicator based on the just on the high or low, a volatility based on just a high or low range would fail to capture the volatility from these gaps or limit moves. And so what Wilder did was create the true range to help reflect this, capture this missing volatility. So for instance, if you were looking at this market, just these two candles here, you could not really take the previous, the current high and low range as the volatility because it would miss this gap here. So you would also take the current high less the previous close. So this will be from this point here to this close here, and the current low less the previous close. So you would take the greater of the three in this point from the current high to the current close. And this ensures that we capture any of the missing volatility for this day. Because if we just take the current high to the current low, this only captures this part of the candle. But as you can see, we take the greater of these three here, the current high to the current previous close, and this is this area to this area here. Okay, hence why we take the greater of these three to capture that missing volatility. As I already alluded to, the ATR is not a directional indicator, guys. It really is not a directional indicator. Like the ADX, for example, which is a trend-based indicator, it does not provide direction. It's just a measure of volatility. So an ATR, just to be clear, the true range reflects a volatility in absolute value, in absolute values. In other words, the ATR is not shown as a percentage of the current close, and it's not shown as a percentage of the current close, and we always remove the negative sign, so they're always absolute values. So the key point I really want to emphasize here is do not try to compare the ATR values with other markets. So an easy example of this is I always remember this example because it really made sense to me when learning about this indicator, is through a high priced and a low price stock. So the higher price stock will naturally boast a higher ATR, right? So if we're looking at a stock trading at say $600 against the stock that's trading say at $5, the ATR, the absolute values are just not comparable because the $600 stock will have a greater ATR, wouldn't it, in absolute values against a $5. So the $600 could have a daily, an ATR of $10. It's very unlikely the $5 stock's going to have the same, isn't it? So we need to bear that in mind. So you cannot compare the ATRs between securities. Right, so how do we use this in our trading? Let me just remove these. How do we use this in our trading? So unlike the Bollinger Bands, which really offers me signals, I use the ATR to enter and exit trades. In other words, I use it to put a stop loss in order to gauge a stop loss and also to gauge take profit orders. So when the ATR is high, so when we have a high ATR level, so say on the euro dollar, we have 160 pips for a daily ATR. This is great. This traders will need to be prepared for the greater volatility and the wider price fluctuations. Therefore, they would set, or I would set my stop. Your stop would have to be to include the ATR, or one ATR level would have to be greater than say 160 pips. At this point here. to avoid really being kicked out of the market, kicked out of a trade prematurely. Vice versa, when the ATR indicates lower volatility. So if we go down to here, as you can look to the right of the screen, we see it's around 76 pips rounded. Traders may adopt a closer, a more tighter stop loss. So as you can see, although this is a volatility indicator, it is different in the way I use it. And I'm sure many traders use it the same as well. You may have even heard of so in terms of a trading stop, what you can do is you can employ what's known as the chandelier exit. This is a trailing ATR stop. I do believe they are available on MT4 and MT5, but you do need to download them. They are not inbuilt, as far as I'm aware. If they are, they're hiding somewhere. You're more than welcome to tell me, guys, if you're aware of where that is. But on the TradingView platform, it is available. So what you can do is you can click on the inputs here, and as you can see, the ATR multiplier. So at the moment, it's at 3. You can also use that at 1. So you can change this, and then it will show as a look at that. I mean, the trading stop doesn't give you much, right? For a 1 ATR move, and that's based on an ATR period of 14, the default period. So as you can see, if we enter short, let's just go back to an ATR multiplier of 3. That would make it easier. Okay, an ATR multiplier of 3. So imagine we're short from this point here. We can use this, the ATR multiplier at this point here, and our stop would be above here. So we would enter here, stop, 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 stop. We would trail. It's as simple as that, guys. We use this to trail our stops behind these ATR multipliers. So it's a multiplier of 1 ATR, nothing more, nothing less. So just to recap on the ATR, I use this to exit trades in terms of my stops. So I would always ensure that my stops on my traded time frame are in line with the ATR. Sometimes, look, if there is clear support or clear resistance, I will not take the ATR into consideration, and I will just use price action to base my stop loss on. In terms of exiting trades, you can also look for look to target 1 ATR, 2 ATRs, and things like that. So it's certainly of use in that sense. Okay, so look, guys, thank you very much for bearing with me for nearly an hour. I do hope you have gained something from this presentation. As you can see on the slide, any comments and feedback can go directly to our support team at fpmarkets.com. The emails are in the chat box. You can also email the market analyst desk directly at marketanalyst@fpmarkets.com. Now, please do consider looking at our Trading Academy. This really has a number of good in-depth videos available for newer traders to learn and develop. So there will be links in the chat box. The FP Markets Trading Hub as well, packed with educational content in terms of analysis, daily analysis, weekly analysis, and market events and such, and as such. In terms of the next event in terms of the next webinar, I'll be live again on the 13th of April, and we'll be looking at exploring Trading Central with FP Markets. So we now have Trading Central live and kicking with FP Markets, and we're going to explore that in more detail, all of its functions. So, and that's at 9 a.m. GMT. I'm just going to quickly run through anything I've missed. Okay, excellent. So look, thank you very much, guys, for your time. Thank you very much for spending an hour with me. As I said, I really do hope you have gained something from this presentation. Have a wonderful day. Take care, trade safe, and I'll see you all again very soon. Goodbye.